Welcome to TradersArmy.com, defending your right to build wealth and preserve capital for generations to come. Hey everybody, 20th of January 2018. Hope everybody's having an absolutely amazing weekend. Welcome to the weekend edition of the Daily Market Commentary. I am your host, Chuck Fulkerson. Welcome all of you, TradersArmy.com, subscribers and listeners joining us in as well. So today, what we're going to do is do what we do on the commentary every day, where we take a look at the same markets to identify potential moves and turning points. But on the weekend edition, I like to look at a little bit bigger picture and look at a little bit bigger scale. So let's go ahead and dive right into it. Now, for those of you that are new to the commentary or to the channel, we do this on a daily basis where we look at short-term trading and investing opportunities. And then for TradersArmy.com and for those of you that watch the weekend edition, we look at a little bit bigger time period. So you're certainly welcome to watch the daily edition as well. Let's dive in. The SP 500, you can see that we've got a couple of areas already marked. And remember that we don't remove the lines from our charts, as we want to make sure that we kind of maintain those levels and those areas. So we had a breakout long opportunity in here just above 2810. We had talked about that was a potential breakout to the upside. I will tell you, as much as I would get into this on a Monday, a Tuesday, a Wednesday, or even a Thursday, I did not get into this. And the reason I didn't was very simple. I don't want to hold things over a weekend on the futures markets. I'm not comfortable holding a lot of things when, over the futures markets on a weekend when we literally break out in the last hour before the market closes. I still like the setup. I still like the format. And so many of you may have gotten into it. If indeed we come back, we open up on Sunday night where we don't get a huge move, I'm going to have an entry probably placed right here. Now, if you did take the long on the breakout, your stop's got to go below here. This is our last pivot low before the breakout to the upside. So your stop has to be below 27.95, below 27.96 to really follow the rules of a breakout long. So I did not jump into it simply because it was the very end of the day on a Friday, overcoming the holiday, or it was not a holiday weekend, it was overcoming the weekend. So, there's still an opportunity, I think, somewhere in here, especially on the smaller time period. You're going to see there's going to be a little bit of a fair price value area that's formed right in through here. So that fair price value area could be a chance to get long on a retest, possibly even this area right here coming back. So I'll be very, very interested to see what happens to it on Sunday evening when the markets open back up, and if you want to stay long that thing, I think you're going to get a pretty good opportunity to jump back in. Looking at this on a bigger picture scale, I want to look at the S&P 500 in general. Here's the SPX, and when I look at this on a daily chart, certainly we've seen that we had very strong move up from the beginning of the year. We've popped kind of above that breakout area. We've really only had 2 red candles since the beginning of 2017, right? So in the S&P, we've only had 2 red candles since the beginning of 2017. Technically, we had one other down day, but we've only had 3 negative days in 3 weeks. And, that's kind of unheard of, if you will. I think that we could get a little bit of a rollover and a pullback. I'd love to see us continue to bounce higher, no question. I'm not changing my bullish stance at all. There's really no reason to change our bullish stance. When I look at this on a weekly time period, you can see that we are, 3 straight weeks in a row of essentially parabolic movement. And to get 3 straight weeks in a row like this, of this angle, and I always go back and look at the angle because I think angles tell us a lot. And I go back and look at the angle of the move. And when I look at the angle of this particular move, as I think I've done here in the past, let me make this a bit wider so it's very easy for everyone to see. When we look at the angle of this particular move, let me duplicate this drawing so I have another one. I can go back and I see that we had one towards the end of last year, but really even going back, 2012, no move up has had as sharp of an angle as we've had. Even all the way back into the 2003 to 2008 time period, These last few months have been unprecedented. You got to go all the way back to essentially 1998 to when we had the last kind of move up of the sharpness that we've had here. Now, that move up was followed by a few months of consolidation, and then another little move up and a few months of consolidation. So I'm not saying that's what's coming, but I just be aware that we are in very much unprecedented territory with the angle at the move up that we've seen here. This is a very, very sharp rise in the S&P. Be happy for it, be thankful for it, but for your longer term investing, make sure that your stops are kind of in place and that you are protecting yourself, right? You don't want to give away too much of the gain that you've had. That being said, my stop losses are still somewhere down in this range here. I've got to give a little bit more wiggle room in my investment life, so that I'm not just getting stopped out on at this point, a 5, 6, 7, 8, even 10% pullback is not going to be enough to stop me out of some of my longer term positions, because we've gone up so far so fast. It's required me to have a little bit more wiggle room in my investment stop losses. Looking at the NASDAQ, the NQ, so the NQ has also breached the breakout point. And I like these, ascending triangle patterns, if you will, where we get a touch, 1, 2. Now, this isn't an official ascending triangle because we didn't actually touch this upper line at quite enough times. So it's not a full triangle, but anytime I've got relatively the same highs and rising swing lows, that tells me that we're running out of sell orders in this area, and that the buyers are really starting to just kind of take over and take control, and that's where we got a little bit of a breakout. Now, in the NQ, that breakout was not as strong as it was in the S&P, so I still think that, if you want to go to a smaller time period, you may get another bite at the apple somewhere down in here. If you did take the breakout, your stop has to go down below here, down below 68.10, in that range there. Looking at crude oil. So crude oil did bounce off of our level, and we got a nice little move off of there. If you're still in this position, then you've got, looks like you picked up about 50 ticks. So that one moved for a pretty nice little move of about 50 ticks, and so hopefully you're able to catch that move. If you held it over the weekend, then you've got to be okay with the over the weekend hold. I personally, like I have said before, I'm a little nervous holding things over a weekend when we've had such parabolic moves. It could just be me. It could just be, it's my own risk tolerance. And frankly, that's cost me in the past opportunity. It's cost me opportunity to not hold things over a weekend, but it's never cost me money to hold things over a weekend, if that makes sense. So I'm willing to give up the opportunity in exchange for protection. And that's kind of what my belief is. So it's up to you as far as your risk tolerance, whether or not you held this thing over the weekend. On the big picture scale for crude oil, looking at this on the daily chart, I think that we put in a little bit of a reversal candlestick on a daily chart. This is a nice little hammer candle after a pullback down. So this could be another entrance for a chance to get long on a trend line level. That hammer candle, the body bounced right off the bottom of a trend line. If you really connect those bottoms, we're not even quite there yet. So we could even have another down day before then popping back up. For those of you that utilize some of the different indicators, you might actually see that we are coming down to a pretty key moving average. And now I'm getting the spinning blue wheel of death. So I would check those indicators, but it looks like I can't at the moment. So we'll check those in a moment. There we go. So let's go to add a quick study, and we will just throw on, actually, I think I've got it pre-saved. We'll look at our moving averages right in here. So we can see that we are way high above our 20-period moving average. This is the 20-period simple moving average, but what I'm going to do is throw a 13-period exponential moving average on there. And the reason for the moving average exponential, the 13, is that's a really common moving average that a lot of traders will use. If you've never used the 13-period moving average, the 13-period moving average is especially the exponential one, is considered a very, very common moving average that has a lot of algos that are buying off those averages. And as you can see, we literally came down right to that 13-period daily moving average. It's highlighted here in green, and we just touched it. So I'll change the color there because it's a little hard to see in green. Let's make it, we'll make it orange, and we'll make it a little bit thicker. All right, there you go. So you can see that 13-period moving average, we literally just came down and touched it. So that is really where we got our bounce off of, not simply because of the 13-period moving average, but all of these things add together, right? Any reason that people have to buy drives price up. And if it's a technical sell, a technical buy signal like a 13-period moving average or a 20-period moving average, there's enough electronic trading systems out there that buy off of these very common moving averages. That's kind of why I look at Fibonacci retracements occasionally, because there's enough electronic systems that buy off of those. Any reason that causes more buyers in the area is going to cause that level to work that much better. Now, we looked primarily at this fair value price area to tell us where to place our entrance. And let me remove all these studies. We looked primarily at the fair value price area to see where we would want to get in. And then that 13-period moving average just kind of helps that area to move. So as far as bigger picture, like looking at it on a weekly time period, there's plenty of room for crude oil to continue to run. We've kind of come above this area through here. Our next stopping point isn't until up here and around $75 a barrel. So, we've got lots of room for crude to run. In fact, it can run all the way up to here. So crude could be a good opportunity if you're looking for a potential flight to safety on your big picture investments. So could gold. Looking at gold on a weekly chart, a time period, a weekly chart. We've got this. It just seems like 1,400 an ounce has been a very strong fair price area that a lot of people have been using as kind of a resistance point in gold. So that 1,400 an ounce. But if you notice here, we just keep getting a bit higher above it. And I think if we break above there, we can go to 1,600 an ounce. So it's fairly far away. If I'm looking at it from a trader's perspective, if I'm a day trader or an intraday trader, we had this huge run up in gold. And those of you that watch our daily market commentary saw that we were able to catch this very, very bottom and then just ride the candle to candle style all the way up. We have since had another little bit of a reversal, and today we got another potential entry on a candle to candle style of trade. Now, that being said, I don't like these upper wicks for a short-term trader. These upper wicks here indicate that the buyers are unable to hold on to their gains, right? So we have all those upper wicks those last couple days, 4 days in a row of upper wicks in the candlesticks tell me that the buyers are having a little hard time holding on to their gains. So when I look to the small time frame areas, my areas that we've got outlined as potential buy points still hold true. Let me remove all those other areas here. So this area is still very valid, right around 1,300 an ounce. If we kind of come down into that range, there's really nothing I like between here and there for high probability turning points for reversal trades. Looking at the bonds. So the bonds continuing to just get hammered. And, as we continue to raise rates, you will see bond prices continue to fall. I think that there's a really good opportunity if we bounce up for a couple of days to get short and catch this macro trend. Looking at it on a weekly time period, you can see that we have finally broken below this kind of support line. We closed below that support line for the first time in a really long time. There's plenty of room for bonds to come back to where they were in 2010. I think we could easily come back down to our 2010 levels in the bonds. So from a trader's perspective, I'd be looking for a rally up to a small time frame opportunity to get in. And the most recent one is right about here, where we had this rally, this little bit of sideways fair price area before price fell away from there. Still have this one up here, but have really been unable to get back into any high quality opportunities. So we'll see if we come back into this one on Monday as an opportunity, or Sunday. Sunday. We'll see where we open up on Monday. Looking at the Aussie, so the Aussie's continued its march higher. We've still got our buy point here in the Aussie. Looking at this on a weekly time period. seeing continued weakness in the dollar. I think that the Aussie has room to continue to run higher, and the dollar has room to continue to fall, which also, bodes well for our opportunity in the euro. So our euro trade still intact right here. Whenever price does indeed return there, looking at it for the daily chart, we can see that on our daily chart we've got a level somewhere right in here. If price does indeed come back to there, that was a nice little touch and go out of that opportunity there. The Canadian dollar. Canadian dollar has just been chopping between our areas now for literally this entire year. So these are in between two areas where I'm not sure we're going to get any decent reversal. I'm going to put a potential area in here. It always feels like the Canadian dollar, always the bridesmaid, never the bride, as price almost touches and doesn't seem to get in. And that's what happened really on this breakout below here. We almost touched it and didn't get in. So I haven't had a trade in the Canadian dollar in well over a month, simply because none of my areas have been touched. And that's okay. I don't want to force it. When good opportunities present itself, we align them and we set them up. And if they show up, great. And if not, that's okay as well. Looking at our final futures markets, looking at our copper, we've got our copper area still in play on the hourly chart. Great British pound still down here below for an opportunity. And then looking at Japanese yen is also fairly far away. I want to open up this yen, though, and look at this on a bigger picture scale. The yen, you can see the yen's really done a whole lot of nothing. And as far as relative strength against the dollar, it's probably the weakest of all the other currencies against the dollar. So if I'm going to look for a long opportunity, it's probably not going to be in the yen, simply because it's weaker than all the other opportunities that I would have in my different currencies. So with that being said, I'm going to turn this thing off for the week. Always remember, fiercely protect your capital. And if you guys need anything, certainly feel free to reach out. I will see you soon. Have a great day.